All right. On this one, the following information from June 30, post-closing trial balance of Bessel Hardware. So this is after you've taken the unadjusted trial balance, you've done those accruals and deferrals for both revenues and expenses, and you've come up with an adjusted trial balance post-closing. So it gives you a list here of all the debits and all the credit balances, and it is asking you to prepare a classified balance sheet. So a classified balance sheet, we're going to always use the name of the company, the name of the financial statement, which is the balance sheet, and June 30, 2011. This is not measuring activity. A balance sheet measures a moment in time. It is a representation of all of the balances of assets, liabilities, and stockholders' equity at the stroke of midnight, in this case on June 30th, 2011. It is not for the year ending. All right, so we'll start with assets. And a classified balance sheet can have 4 subcategories, the first of which is current assets. Is gonna have little subcategories. No, assets are 4 and then 2 each in liabilities and stockholders' equity. So the asset has up to 4. Now you may or may not have all 4, but it will have 4 for the purposes of this class. Okay? So current assets are cash, what you're going to turn into cash, what you're going to sell, and what you're going to use up in the next 12 months or an operating cycle, whichever is longer. And then this one section of the balance sheet has a specified order. The assets and current assets are ordered in order of liquidity. They're listed in order on how close to cash are they. Well, cash is already cash. So you're always going to start with that. And in this case, we have $64,000 in cash. Yes, sir.
Current assets are what you're going to buy and sell?
Current assets are cash, what you're going to turn into cash, what you're going to sell, and what you're going to use up. So cash, what you're going to turn in. So what are you going to turn into cash?
Houses, supplies.
Well, cash you're going to turn into accounts receivable is going to turn into cash. Short-term investments going to be turned into cash. Notes receivable are going to be turned into cash. All right? All of that you're going to collect from your customers, or you're going to sell your short-term receivables. It's by definition, you're going to turn it into cash because it says short-term. So management's intent, whatever those investments are, whether they're marketable securities or bonds or whatever, management's intent is they're going to sell it sometime soon. So short-term investments. Is the next one on our liquidity list. That's going to be next. Short-term investments can be sold and turned into cash within an hour. You can You can just go onto your brokerage account and say, sell all my Boeing stock. Done. Okay? So it's very, very liquid. Short notes receivable. Notes receivable has a promissory note backing it up, a legal document. So it is more liquid than accounts receivable. You can collect that through a court of law if necessary. Then accounts receivable. You can collect them with a phone call. You can call your customer and say, please, 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 send me my money. I need to make payroll. You can sell it. You can sell accounts receivables called factoring. There are lots of companies out there that'll buy receivables, as do some banks. So this is cash, what you're going to turn into cash. Next is, what are you going to sell? Well, you're going to sell your merchandise inventory. $290,000. So that's what you're going to sell. And then lastly, what are you going to use up? Well, you're going to use up the prepaid rent. $3,200. You're going to use up the prepaid insurance. $9,600. You're going to use up the sales supplies. $2,560. You're going to use up the office supplies. $880. And you're going to use up this deposit for future advertising. $7,360. Add all that up together. You get $1,015,600 in total current assets. That's the first of the potential 4 sections. The second one is investments. Investments can be tangible personal property that is currently not being used in the business. It can be investments in other companies that management's intent is to hold on to for more than a year. Things like that. Things that are not currently being utilized in operations. And it has in here, it says, right after that deposit for future advertising, that we have a building that we own that is not in use. So that's an investment. Bill? It's part of it. It's a building. It's something we own.
So it's just stuff that's not being...
Not being currently used in operations. Okay? That was worth $99,200.
But,
Yep.
so, but wouldn't investments kind of like screw up your balance sheet, like in real life, like if like one of the investments fail? Like if you're supposed to make...
You can lose money on it, absolutely. But you could lose money on these short-term investments as well.
Right.
So, yeah, but there are good, solid business reasons for making investments in other companies.
But like, let's say you lose money on an investment, like...
Then it's a loss that you put on your income statement when you sell it. It's not until you sell it that it goes to the income statement for the most part. Okay? All right, then we have property, plant, and equipment. These are all of the tangible fixed assets that we are currently using in our...
So I got a question.
Yes, sir.
Why you want the 99,000?
Because these totals for these sections will eventually be added together to come up with total assets. So what I'm doing is on items where I have more than one account, then I list them in that first column so that I can separate them out, just to give it a little bit more structure, make it easier to read.
So these are not in terms of credit and debt?
Nope, not just columns for organizational purposes. So property, plant, and equipment. So we have some land for $46,800. And we have some delivery equipment. Delivery equipment is depreciated, so I'm going to use a third column for it. So it has an original cost of $82,400. But we have to subtract from it the accumulated depreciation. I'll abbreviate that. $56,800. Subtract that, and we get a net book value of $25,600. Add that to the land cost, and we get total property, plant, and equipment of $72,400. For total property, plant, and equipment. And the very last section is intangible assets. These are items that have no physical substance. They're still items that we own in order to conduct our business, but doesn't have anything that we can hold or touch or walk on. Trademark. Is the only intangible that we have, and we have an $8,000 cost in that trademark. Add up the total current assets, the total investments, the property, plant, and equipment, and the intangible assets, and we get $1,195,200 as total assets. Intangible, Intangible. I know, my writing is just awful.
What is it?
Yeah, intangible assets.
And those are the same four categories that are all times?
For this class, for purposes of this class, those would be at most the only four categories that we would use. All right? So then we have liabilities. This has, at maximum, two subcategories. So we have current liabilities, this is everything that we have due and payable in the next 12 months or an operating cycle, whichever is longer. So this is all of the things that we're going to pay in cash in the next 12 months. So it starts with accounts payable, for $229,200. We have salaries payable, $10,400, and interest payable. $3,680. Add those three together, and we get total current liabilities. Of $243,280. So everything else that we owe money to, if we're not going to pay it in the next 12 months, then it's a long-term liability. And they only have one. They have a notes payable. Of $160,000. Add the current liabilities to the long-term liabilities, and you get total liabilities of $403,280.
Is $160,000 the notes payable?
The note payable, yes, sir. Yeah. Then the last section is stockholders' equity. Stockholders' equity, just like liabilities, has two possible sections. Contributed capital so we have common stock, and this common stock has a $1.10 par value. With 40,000 shares authorized issued and outstanding. So that equals $44,000. And that's 40,000 shares times a par value of $1.10. So $1.10 times 40,000 shares. All right? Then we have paid in capital in excess of par. That's 320,000. So if you sell the stock, you issue the stock to the shareholders for more than $1.10 per share, then the rest of the cash that you've received goes into this other contributed capital account called paid in capital in excess of par. So that gives us total contributed capital of $364,000. And to that, we're going to add retained earnings. And in this case, it's $427,920. Add those two together, we get $791,920 of total stockholders' equity.
So which values are which? Is the 364 paid in capital?
No, the 320 is the paid-in capital. So the common stock, $1.10 par value, 40,000 shares authorized, issued, and outstanding is the 44,000. The next line down is paid-in capital in excess of par value. That's the 320. And then total contributed capital here. I'll just draw some lines to it. That one goes there, and then this one goes there. Okay? Total contributed capital is the 364. So retained earnings then is the 427,920. Add those two numbers together and you get the 791,920. Yes.
Is that what we're going to have to do on the test?
Yes. Something similar. Add the total stockholders' equity to the total liabilities, and you get the grand total of total liabilities and stockholders' equity. Which equals the same $1,195,200 that we got for total assets. Right. Yep. And that's why that big long piece of paper, that ledger paper that I give you, it has 4 columns. So you've got plenty of room to put like the property, plant, and equipment, the building, like the equipment less the accumulated depreciation to come up with a total, add that to land, come up with a total. So you've got enough room to spread it across the 4 columns in a nice organized fashion. Okay? And my midterm question will not be anywhere near as complex as this one was, so yeah. Yes, sir.
Back on over there, under property, plant, and equipment, do you have to indent less accumulated depreciation?
You don't have to. I did, but you don't have to. Yeah, you could put them right underneath delivery equipment. Yes, sir.
Can you place an asterisk on all the subcategories?
Yeah. So we have current assets and its total. We have investments, which didn't need a total because it was just one. We have property, plant, and equipment and its total. Intangible assets. And then current liabilities, its total. And then long-term liabilities. Once again, only one account, so it didn't need another total. And then contributed capital and retained earnings. And then we have a total for contributed capital.
And for the sake of our class of our test, there's only going to be the 4 categories, the 2 there. And 2
At most, for this course, at most you'll ever see is 4 categories of assets and then 2 each of liabilities and stockholders' equity. Yeah. That's at most you're ever going to see. In reality, there are, if you go on to intermediate accounting, there are some additional asset categories. Mainly other. There's a category that sometimes appears down at the bottom, just says other assets or other liabilities. They don't fall into either category. So, all right? Questions on this one? And we're spending 2 days on this, so, this is just the start to introduce it. All right, let's go on to the multi-step income statement, which is the other half of these 2 chapters. So page number 236, we'll do problem number 7. So problem number 7 on page 236. All right, the multi-step income statement. What this one is that once again, in order to provide an extra level of organization and to better inform the readers of our financial statement, the multi-step income statement takes the regular income statement that we did during chapters 1 and 2 and for the first midterm and creates subtotals. So the balance sheet has subcategories. These have subtotals in order to provide a higher level of organization. So we're going to do, in this one, it says the following statement that follows are for Kudzel Hardware Corporation. And then it gives you the total revenues, and this is a single-step income statement like we did for the first midterm. All the revenues, they have net sales plus interest income, and then all of the expenses. They've got cost of goods sold, selling expenses, general administrative expenses, interest expense, to come up with income before income taxes. And then they subtract the income taxes to come up with net income. So that's exactly what, and they're presenting 2 years. I'm just going to focus on one. I'm just going to focus on 2011. So on this one, same as always, Kutzel, or however you say it, Hardware Corporation. The income statement. Now this, unlike the balance sheet, this statement is measuring activity. So it is going to be for the year ending. July, in this case. So we're going to start with net sales. And in this case, it is $464,200 for the year ended July 31st, 2011. Yes, sir.
Why is it year ended, not year ending?
It can be either one.
Okay.
Yeah.
And then, so was the last one we did just a multi-step balance sheet?
It was called a classified balance sheet. Yeah.
Do we need to start with revenues? Or
Yeah, well,
what kind of,
for this one, we don't really break it out revenues because we're going to have all these steps. Because revenues include this interest income, and we're going to put that in another section. So we're not, it's not all of the revenues that were generated by the company. So just start with net sales. Then we're going to subtract cost of goods sold. Which is $243,880. Subtract that from net sales, we get our first subtotal, $220,320. And that is gross margin.
So why don't you put less?
You could, it wouldn't be wrong to put less cost of goods sold. It also wouldn't be wrong to put brackets around this to indicate that you're subtracting. It's just options depending upon the style of multi-step income statement that you want to put in. So you certainly, if that makes more sense in your mind to put less cost of goods sold, it will not be wrong. That's a perfectly acceptable way of showing that.
So what is the gross margin?
Gross margin is, in essence, because cost of goods sold is the direct cost of the product that they sold. Okay? So this is the profit they're making directly on the individual items that they have in, I'm assuming, a hardware store or whatever it is the type of company. Okay? All right. From this, we're going to subtract operating expenses. We have selling expense. Selling expenses would include like any commissions that we pay the sales staff, the salaries of the sales staff. If we've got them in delivery trucks or vans and they're driving around town, it may be the depreciation on those trucks or the gas and oil that goes into those trucks. It could be the depreciation and maintenance of furniture and fixtures on our sales floor versus the administrative offices. So anything, advertising is a selling expense. So anything directly related to the process of selling our product. Okay? So we have selling expenses, and in this case, it was $95,160. And then we have general and administrative. $90,840. Add those two together, we get total operating expenses. Of 186,000 even. Subtract that from the gross margin that we made directly on the products that we sold, and we get our second subtotal. $34,320 is income from operations. So of our day-to-day business, the stuff that we do day in and day out, this is the money that we made. To that, we're going to add or subtract other revenues and expenses. This is where we're going to put items that are outside of our core operations. And in this case, we have both interest income of $1,420, and we have interest expense of $5,600. Add those two together, we get, and in this case, the expenses exceed the income. So we'll say excess of other expenses over other income, other revenues. And that was 4,180. And a negative number. Subtract that from the income that we generated from other operations, and we get 30,140 income before income taxes.
Is the reason that you're subtracting that 4,180 because negative?
Correct. Our expenses were higher than the revenues that was generated from the interest income. Yes?
If it was a positive number?
If it was positive, if this was higher, if the income, the interest income was higher than the interest expense, it would be a positive number, and what we would change is we would say excess of other revenues over other expenses. So we would just flip that little.
So we would still subtract regardless?
Nope. If the revenues were higher, then it would be an add.
Okay.
Yes. Because the other thing that you commonly see in this section are gains and losses on fixed assets that we sell. So let's say we stopped using a delivery truck, and so we sold it. If we sold it for more than the book value, the original cost less the accumulated depreciation, then we would have a gain on the sale of delivery truck. And so all of that goes into that section there, because that's not what we're in the business to do. We don't get up every morning to sell delivery trucks. It's just something that happens in the normal course of business, but it's not part of our operations. All right? So this is income before income taxes. And then from that, we subtract income taxes. In this case, it was $8,000. And we get $22,140 as net income. All right, so our subtotals in the multi-step income statement is the gross margin, income from operations, income before income taxes, and net income. So those are the 4 steps in a multi-step income statement.
So why didn't you indent other revenues and expenses?
I did. Interest income and interest expense. Those were the 2.
You just don't have to do the title or the other.
Well, yeah, this is just a category title. So it's, I guess you could, just to give it a little bit more structure. But you would also then need to indent the operating expenses. So if you were going to do that to stay consistent, I would indent both of those. But it wouldn't count off. It wouldn't be wrong whether you did it one way or the other.
So these are like the margin subcategories.
It's subcategory. It's multi-steps. It's just calculating steps along the way. Yeah. All right. Let me pull up your textbook. I'm going to introduce the Excel problem. So 40 points of your 500 points that are available in this class come from a Excel assignment. And I'm going to introduce it now, and then I'm going to focus on it on Wednesday, in order to tie together both the chapters that were chapters 3, 4, and 5. Yes? It's due the Sunday before spring break. So spring break is the 8th through the 9th through the 14th. And so it's due that Sunday. So get it done before spring break. Okay? It's a month. It's due in about a month. All right? And I'll look at that and maybe I'll change my mind on that. Okay. On page 195, it's a supplement to chapter 3 on closing entries and using the accountant's worksheet. Actually, come on. All right, on page 195, problem number 3. It says Beauchamp Theater Corporation has a trial balance at the end of its current fiscal year. These are all unadjusted balances. So we have not made any of the 4 top possible adjusting entries for this corporation yet. So we haven't done the deferred revenues, the accrued revenues, the deferred expenses, or the accrued expenses. So it lists cash, accounts receivable, cleaning supplies, land and building, their theater furnishings, along with the applicable depreciation on both, the office equipment, their liabilities. Included under liabilities is a gift book liability. You know how theaters, you can buy tickets in advance and then give them out as either Christmas presents or to your employees. So they have a gift book liability. They got a mortgage payable, common stock, and then the income statement items of ticket sales, theater rental revenue, usher wages, office wages, utilities, and interest expense. So that's their trial balance. They then provide you with entries that are needed, A through I, that are needed at the end of the period in order to make an adjusted trial balance. So they tell you that insurance is expired. They have what the inventory of unused office supplies as well as what inventory of unused cleaning supplies. So you take a look at the balance in each of those 2 accounts. You compare it to the inventory that you have at the end of the period, and that gives you how much was used up throughout the year. They tell you what the depreciation for the building, the theater furnishings, and the office equipment. So you don't have to calculate it. They tell you up front, building depreciation for the year is $14,000. And I'm going to be going over this again on Wednesday. So I'm just introducing it now, and I'll tell you why I'm doing that here in a second. So when they sell all of these gift books, they credit it to this liability account's gift book liabilities, the very top up here. It currently has $41,900 in the balance. So that's throughout the year, that's how much they've sold of these gift books. It is estimated as of the trial balance date here that $37,800 worth of these gift books had been redeemed. So of that $41,900, $37,800 has been turned in for movie tickets. So you need to reduce that, and then you've now earned that revenue. And then it tells you what the accrued but unpaid wages are and what the federal income tax is. So your assignment, which we'll start on here on Thursday, on Wednesday, why do I keep wanting to make you guys come in, is you're going to create an accountant's worksheet with this trial balance, make the adjusting entries, one balance sheet account and one income statement account for all of the accrued or deferred expenses that are needed, plus any accrued and deferred revenues that are needed. And we only have deferred revenues. Just those gift book liabilities is the only revenue entry that's needed. So you'll only be making 3 out of the possible 4 types of adjusting entries. All right? So if you want to bring in a laptop on Wednesday and follow along, I'm going to solve this problem and record it for you. I'm going to show you how to do it, because this is a test of you being able to not only do the adjusting entries, but also how to do this in Excel, because you must start with a blank Excel spreadsheet. Do not start with one of your friends or your roommates or your older brother or sister's roommate, because I will be able to tell. And I'm not going to tell you how I know whether you started with a blank worksheet until after the assignment is turned in. But I can tell. Okay? So if you want to get a start with it, just start by listing the accounts that are in here. Just take a blank Excel spreadsheet and just type in cash, accounts receivable, prepaid, blah, 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 all the way down. All right? And then what we'll do is on Wednesday, we will go through, and at the end of it, your spreadsheet will look something like this. Something like this. I know it looks very complicated. It's not. I'm going to do it in less time that we have on Wednesday. I'm going to start from this and go to this in less than 75 minutes. All right? Now, that's just the first part. There's more. Once you get the adjusted trial balance and split it between the income statement and the balance sheet, you then can do the actual income statement, multi-step, the statement of retained earnings, and the classified balance sheet. That's the Excel assignment. It's worth 8 quizzes, and you have time. And I've already set the due date. I'll look. It may be after we get back from spring break. I'll have to confirm that. It's all the same problem. This is all the same theater corporation.
What we have to turn in
Is the same one. Yes. And I'm going to walk through it on how to do it. All right?
We use like all the formulas if you want.
Yeah, you have to use the formulas. Here, these are my formulas.
What is that?
It's due, I'll confirm between now and Wednesday.
What are those formulas?
Oh, these formulas, I go over to the accountant's worksheet and I pull not only the balances, but I pull the account titles also. See, all I'm doing here is switching. Where it says cash, accounts receivable, prepaid, and all that, that's actually a formula.
No, yeah, I know.
Makes it fast. Because you don't have to retype it all. Okay? Even the income statement. These are formulas. You know, the ticket sale revenue, the gift book revenue, and the theater revenue, you already have all that written down. It's all right here. No sense in retyping it. Just put it over in the other tab. I'll show you how to do that. I'm very fast. Okay? All right. Have a good day.